Are you in the healthcare business or just getting started? Are you concerned about ensuring the financial integrity of your business? My name is Carl Pierre, and I'm the co-founder of Passive Workforce, the top healthcare consulting firm in the country. In addition to my role in running this reputable firm, I'm actually involved in mergers and acquisitions, constantly expanding my portfolio of agencies. Through my experiences, I've witnessed firsthand the detrimental impact of inadequate financial management on companies, often resulting in the inability to secure financing and sabotaging potential transactions during crucial sales. Understanding the importance of maintaining meticulous financial records, my team and I at Passive Workforce strive to provide invaluable recommendations to our clients. Today, I'm excited to share with you my top 5 recommendations for keeping exceptional financial records so that your company is always audit ready, credit worthy, and in the best position to get top dollar if you ever decide to sell. The first tip of 5 is that you have to have a good accounting software system, ensuring accuracy and the efficiency in your record keeping. One of the most widely used accounting softwares for small and mid-sized businesses is going to be QuickBooks. Now, QuickBooks is kind of like an industry standard for most small businesses. And if you ask any accountant, most of them will tell you that it's going to be easier for them to manage your books or even do your tax filings from your QuickBooks files. So I usually recommend that our clients or anybody that we're taking on their financial responsibilities have QuickBooks Online, because that allows all the financial records to be cloud-based, your internal team and external auditors to be able to go in, navigate it. It's almost like having the comfort of using Microsoft Office or Google Suites. It's so widely used that most people will learn and know how to utilize those tools. Also, a lot of the QuickBooks files and QuickBooks itself integrate with other softwares, sometimes your payroll providers, sometimes the software that you're using to run your business. So it allows all that financial information to transfer easily between softwares and between accountants who may need access to your books. The next tip is to regularly reconcile your financial statements, properly addressing any discrepancies that may arise. Now, for anyone who's not too familiar with what reconciling your books actually means, it's the process of reviewing all the financial transactions and making sure that your expenses and your revenue has been properly recorded and added to your accounting system. Now, I could give you an example of what I mean by reconciling your books. Let's just say that you issued an invoice for home health care, whether it's a medical claim or an invoice to one of the hospitals that you're staffing in. You want to make sure that that invoice is first entered into your accounting system. And when you receive the check for that service or that payment, you're able to take the actual explanation from that check and match it against the invoice that was originated. So let's just say that that invoice was for $100,000. You want to be able to take that check and match it to the $100,000 invoice and say that this check is actually paying for all these services that were included on my invoice or my medical claims. The same should be happening with your bills and your expenses. You need to have the actual invoice supported by the outflow from your bank account or the check that you issued. Everything needs to match up, because whenever you are audited or reviewed, they're going to ask for proof and supporting documents for everything. Also, you don't want your receivables or your payables to just kind of float from month to month. And at the end of the year, you're stuck trying to reconcile everything when it's been months since the transaction and you can't really remember what the transaction was for. Sometimes it's just a debit card swipe or something along those lines. You don't want to be in the business of reconciling at the end of the year. A lot of our clients do this. It's a really bad practice. You want to be reconciling your books at the end of every single month, or even more frequently than that, so you never miss anything and you have the supporting documents for every transaction that has occurred in your business. Something else to think about when it comes to reconciliation, you want to be on an accrual tax basis. Now, a lot of accountants will advise you in the beginning to just be on a cash basis, which means that you're only recording the cash that's coming into your accounts and the cash that's leaving your accounts. This is also a bad recommendation. It may sound like a good idea from a small business standpoint because it's easier on the accountants. They don't have to think too much. There doesn't have to be much communication between you and them, but it can really misrepresent your numbers. For example, let's just say that you have $500,000 of billing that's due in 30 days, but you pay your payroll weekly. That means that for the month of December, you might have generated $500,000 in bills, but all of your employees have been paid. If you are recording things on a cash basis, you might be showing that your business is negative for the tax year instead of turning a profit. Now, this may be good if you want to pay a little tax burden, but what happens when your business goes to apply for a loan? Your business won't be able to get approved for a loan because you're showing a huge negative, even though your business is cash flow positive. If you can't secure debt, let's just say you're trying to buy your building, you're trying to get expansion capital, it's going to make your business look like it's underperforming. Accrual means that you are recording the revenue as the revenue is created. So the day that the service has been provided or the week that the service has been provided, you're adding that to your system as revenue. And then you're tracking that revenue down the line and saying that that's money that's due to you. You're going to have an agent report. You're going to show that this is money that you should be collecting. Hopefully, you know your collection rate is close to 100%. And this is money that I am supposed to and entitled to get. That is money that you earned. If you do not accrue that, you could totally misrepresent your books and show that you're actually underperforming. Tip number 3 is that you have to establish a structured bookkeeping process, promoting consistency and clarity in your financial data. The first time that I had to do this in one of my companies, it was at the recommendation of one of our CPAs. They said that if we want to be audit ready and have really good financial books, and we're actually starting to build out our financial team internally in the company, he said that we have to absolutely develop an internal control manual. What he did was interviewed every single employee in the company to ensure that they knew their roles in the company and knew what their touch point was when it came to income and revenue or expenses. Who has any sort of financial touch on any activity within the company? And how are they documenting that? And how is that being recorded? Without an internal control manual, it's almost impossible to get to the level of audited financials, and you're going to have a lot of errors in your accounting system. Whenever you're being audited, the first thing that they're going to ask you for is your internal control documents. Whether you're being audited by the IRS or you're being audited by a bank or whoever is really trying to understand the financial health of your company, they're going to want to know, what are your accounting practices? How are you recording and registering revenue? How are you tracking and monitoring expenses? They need to know when your book opens and when your books close, and what is involved in your typical financial cycle. Without knowing those things, they're not going to understand the money movement in your business, or they're going to apply general accounting practices to try to make sense of what you have there. You want to eliminate that doubt, and you want to be professional with how you're recording your data. So going about developing an internal control manual is critical for having good financial integrity for your business. Best practice number 4 is considering employing a skilled financial professional or outsourcing financial management to experts. Most small businesses, when they get started, they decide that they want to manage your books themselves. They're like, hey, you know what? I'll just record this myself. I'm watching my bank accounts. I don't trust anybody else to do this, or it's too expensive for them to hire an external financial team. And because of that, they start off on the wrong foot. And it is really hard to correct, because what's going to happen is at the end of the year, your CPA is going to try to review your books. They're going to misclassify things. You might miss out on the opportunity to claim certain deductions that you're entitled to because it was all misclassified, and they're just going to start lumping together transactions. Some accountants will flat out tell you that they'll charge you $1,000 a month to reconcile your books and to prepare your taxes for the year. And that ends up being $12,000. So as a startup, you sometimes are a little afraid to kind of get into that arrangement, especially if you have no transactions or very few transactions. And I can see how that's scary for a lot of people. You just have to find the right service providers and the right team to help you to manage your books properly, but at reasonable cost. And if you stick around, I'm going to be able to talk to you about how you could do this with people that we highly recommend and a team that we work with, so that you're able to maintain high-level financial integrity at a discount when compared to some of the local CPAs that are going to be charging you a higher rate. Now, our partners, healthcarebackoffices.com, will provide anything from basic bookkeeping to accounts receivable management, account payable management, handling your payroll, handling your medical billing, you name it. So if you need help kind of structuring your financial systems, or you want to start outsourcing that service, just contact us and we'll put you in contact with them so that they could get you on the right track. Tip number 5 is to conduct periodic internal audits to evaluate your organization's financial health and make informed decisions. Some people think that they could just go about managing their financial records on their own. They get their own QuickBooks Online and they start recording the data themselves. Bad idea. You always want to have a third party involved to hold you accountable to the accounting practices of the United States and to also hold you accountable to your own internal controls. Those audits are supposed to be happening periodically. For all you home care owners, think of those audits as being like your quality assurance program. Your financial team is supposed to double check and make sure that all the people who have a financial impact in your business know the protocols and are documenting and reporting things properly. For example, you may have people who are being reimbursed for transportation or reimbursed for mileage. What is your mileage documentation protocol? Are they submitting receipts? Are they submitting a logbook that shows that their origination point was point A and that was 40 miles from point B? Are they submitting gas receipts? What are they doing to capture that information? Who are they giving it to? Is it being logged correctly? Is it being signed off? How's the reimbursement process? Is it following your internal controls as documented in your internal control manual? All these things should be done internally. It helps to improve the integrity of your internal staff and make it a whole lot easier when it's time to do your external audits. You have to have checks and balances within your company. There's just no reason for you not to, especially when your business is all about making money. Your eye needs to be on the money, and the processes behind documenting the money flow need to be on the highest level. And I want to add one more bonus tip since we're talking about audits, and that's to actually have audited financials from a respected third-party accounting firm. We already spoke about having internal audits just to make sure that your internal controls are being followed by your financial team and all the people who have a touch point with the financials of your business. But what about third-party audits? A third-party audit is what you want to have in place because audited financials are more or less the highest standard. And I'll give an example of what I mean. Every single year, you should have a third-party CPA firm, someone reputable, someone that is recognized within your state or on a national level. Obviously, you have the big four accounting firms. They don't make sense until you're about $25 million to $50 million in revenue because their accounting fees are quite high. But having the big four as audited financials from the big four really puts the gold seal of approval on your financial documents. If ever the IRS is reviewing your documents or a company, private equity firm is looking to buy your company out, having those audited financials that have a reputable firm on it really says that these books are clean and they've dug through that process. Now, the reason that you want to have these third-party audits is, again, it lends to the credibility of your overall financials, and then they'll also recommend and find holes in your accounting system. So again, when they're doing your audit, they're going to request your internal controls, they're going to meet with your financial team, whether it's your CPA, whether it's our services, or it's your internal team, and they're going to start asking them to provide proof of everything. They're going to review your financials, first of all. Second to that, they're going to say, okay, could you provide me with the evidence of all your invoices for the month of January? We would like to see the invoices, the supporting timesheets, and all of the pay stubs associated with the outflow of the money to pay your staff. And you're going to need to be able to produce that. Then they're going to ask for singular documents. They're going to ask for a lot of little details. And if everything checks out according to your internal controls and according to generally accepted accounting principles, they're going to say, hey, everything that you're representing here is on par. Everything is outstanding. We trust and believe that these financial records are accurate, and they give you that seal of approval. Having audited financials makes everything easier. It makes it easier for you to get loans. It makes it easier for you to sell your company. It makes it easy when the IRS comes in and wants to try to snoop around your books and generate more revenue for themselves. Audits aren't really awful. The reason people hate audits is because when the IRS comes around to audit you, they see you as an opportunity to collect revenue off of your own ignorance. So if they see that you have audited financials, they already know it's a waste of time to kind of dig any deeper because your records are accurate. What they want to find is a sloppy but profitable agency or company that they could go in and say, hey, oh, you don't have receipts for this, that's revenue. You don't have any proof of this expense, that's revenue. And if you made a few $1 million, let's just say, or even a few $100,000, and they could discredit $200,000 of expenses as revenue, that auditor in 1 week would collect something like $40,000 for the IRS, right? And they're only getting paid like $1,000 to $2,000 a week. So again, this is why I recommend that bonus tip of having audited financials. Now, this is going to add to your costs, of course, but if you're already into the 7 and 8 figure level of running an agency, absolutely pay for it, because that auditing cost of $15,000 to $20,000 may save you hundreds of thousands of dollars when an IRS audit comes into effect, or it could actually help raise the valuation of your company so that the private equity firm or the public company that's buying you out cannot beat you down when it comes to your valuation of your company. If your financials don't match their review, they're going to try to renegotiate the price on you. And of course, you're going to always want to renegotiate the asking price down. And if your books are bad, you're going to allow them to do that to you. By implementing these changes and recommendations, you can protect your company's financial stability, enhance its credibility, and pave the way for future growth. Don't let inadequate financial record management jeopardize your success. Take action today and partner with my team at Passive Workforce to efficiently manage your books or even the entire financial system of your company. With our expertise, you can rest assured that you'll be well prepared to secure the necessary financing or sell your company when the opportune moment arises. Don't leave the future of your business a chance. Empower your financial success with the guidance and support of our team at Passive Workforce. If you want more recommendations and tips on building your business credit or applying for credit cards for your business, check out this video where we dive into the best credit options for new and maturing businesses. Getting business credit is easier than you think.